We are covering the rules for deducting gambling losses. The most critical rule, and the one most heavily tested, is that gambling losses are deductible only to the extent of gambling winnings. If a taxpayer wins $5,000 from the lottery, but has $8,000 in losses from slot machines, their deduction is limited to $5,000. The remaining $3,000 is a personal loss that cannot be deducted, carried forward, or used to offset any other income. It's gone forever. A common exam trap is to present this scenario and ask for the total deductible amount, offering the full $8,000 as a tempting but incorrect answer. Next, you must know where the deduction is reported, as this differs based on the taxpayer status. For a casual gambler, which applies to nearly everyone, the losses are claimed as a miscellaneous itemized deduction on Schedule A. This is a below-the-line deduction. This means two things the exam will absolutely test you on. First, if a taxpayer does not itemize and instead takes the standard deduction, they get no benefit from their gambling losses. An exam question will give you a taxpayer with $10,000 in winnings, $10,000 in losses, but only $1,000 in other itemized deductions, like mortgage interest. If the standard deduction is $24,000, the correct action is to take the standard deduction and get zero tax benefit from the $10,000 in losses. Second, since it's a below-the-line deduction, it does not affect adjusted gross income, or AGI. Gross gambling winnings are included in gross income, increasing AGI. The loss deduction happens after AGI is calculated. An exam question asking for AGI in this situation requires you to include the full amount of gross winnings without subtracting any losses. The rules change for a professional gambler, defined as someone whose activity is regular, continuous, and pursued with a profit motive. Professionals report their gambling enterprise on Schedule C. Here, winnings are gross receipts, and losses are treated as an expense of the business. While these are above-the-line deductions that reduce AGI, the fundamental limit still applies. Total deductions, including losses, cannot exceed total gross income from the gambling business. A professional gambler can never show a net loss on Schedule C to offset other income, such as a spouse's salary. The third critical area the exam focuses on is substantiation. A taxpayer cannot simply claim they lost money. They must be able to prove it to the IRS. This requires maintaining detailed records, such as a diary or log showing the date, type of gambling, location, and the amount won or lost. Supporting documents like wagering tickets, receipts, and bank statements are also necessary. An exam question might describe a scenario where a taxpayer has documented winnings, but only has a general estimate of their losses with no records. In this situation, the allowable deduction for losses is zero. The burden of proof is always on the taxpayer. To remember the key distinction for most taxpayers, use this phrase: a casual loss goes to Schedule A, but only after winnings lead the way. This reinforces that it's an itemized deduction for casual gamblers and is always capped by the amount of winnings they report. Master these distinctions between casual and professional gamblers, the impact on AGI, and the documentation rules, and you'll be prepared for how this topic is tested.